Good morning, everyone, and welcome to the crossover. So we've seen the euro kind of steady itself ahead of NFP at these lower levels, which is to be understandable because there's not going to be much trading ahead of NFP. And then we saw crude come off of those levels, after the concern about the Canadian pipeline some of them being shut down because of the fires. And I don't know if we talked about it here. I know I talked about it when Blake came on, but I said that I showed the 5-minute chart and said we were coming into a pretty good area. I thought that was pretty much it for the crude. And we went a little bit higher, and then I shorted the pit open. Covered a little bit too soon, but I said that on Twitter I was looking for short setups. So we had quite the fall in crude. So let's see where we stand as we come into NFP. Like, that doesn't make any freaking sense. Let me see. I think the euro fell yesterday, but supposedly dollar seats ground before you use jobs report. That's a sack of shit. You know what? Okay, a Reuters survey showed economists expect U.S. payrolls to have risen by 202,000 in April after increasing by 215 in March. A weaker than expected ADP report this week has tempered market expectations of a robust reading on Friday. It will mean a significant upside surprise from the jobs report for the dollar to change trend, said Yujiro Goto, currency analyst at Memorial. We expect gains in dollar yen to be capped around 108, and similarly downside for the euro will be limited. Some large funds have been cutting favorable bets on the dollar and uncertainty over when the Federal Reserve will raise rates. Investors only see a 13% chance that the Fed will hike in June, according to CME's FedWatch. On Friday, Morgan Stanley upgraded its euro-dollar forecast and downgraded its outlook for dollar yen, saying the European Central Bank and the Bank of Japan, which are both battling toward a deflationary pressure, are running out of options to curb the strength of their currencies. It also expects the dollar yen at 103 at the end of the second quarter, compared with its previous forecast of 110, while the euro is expected to rise to 116, up for an earlier forecast of 106. Well, I really don't know about that because I saw some investment bank research for Morgan Stanley, and Morgan Stanley is the best. Nobody can touch Morgan Stanley. I mean, Goldman Sachs kisses Morgan Stanley's feet. Morgan Stanley is so far above and beyond their guard. It's like comparing, NBA All-Stars to a YMCA basketball team. That's how far Morgan Stanley is above everybody else when it comes to FX. Nobody even comes close to it. But the investment research that I saw was stating that they're looking for lower on the euro dollar. So I really don't understand that. I didn't bother to look about the yen, but that investment bank research was, I think, from like yesterday or the day before yesterday. I don't know what they're talking about in this thing. Let me try and quote something. We'll take a look at it. So I really don't know what they're talking about. I really don't. It's stuff I saw yesterday. scroll ahead and try to sort of get something here. So really, I don't know what the hell that story's about. Because this is May the 4th, and it says the greenback back in the green. Morgan Stanley, they are the best. Nobody can even touch these guys and girls. They are so good, it's ridiculous. So it says the U.S. currency is the only economy that can absorb currency strength and resilience of its domestic economy is rooted in internal rebalancing that most of the rest of the world has yet completed. U.S. dollar strength has been a reflection of the relative improvement in the U.S. compared to the rest of the world, as well as a conduit for the U.S. assisting the rest of the world in its rebalancing by importing global inflationary pressures. Our FX team has described the dollar weakness as a correction that has interrupted a secular bull run for the dollar, one that is yet to run its course. Such a path, we argue, is not only likely, but is also necessary if the rest of the world outside the U.S. is to rebalance. Now, this isn't me talking, but it sure as heck sounds like it's me talking. Let's face it, the U.S. economy, this is Morgan Stanley. Let's face it, the U.S. economy is the only large economy in the world that can absorb a stronger currency. China, the Euro area, perhaps to a lesser extent Japan, are all ill-equipped to deal with the stronger currency. But there are important differences among them on this matter. A large chunk of the EM countries, have further to go in their adjustment to a new model of growth, and stronger currencies could tempt central banks to deviate from the commitment to adjusting they've shown over the last year. A weaker U.S. dollar simply isn't in the interest of the rebalancing that the rest of the world needs. Dollar weakness has helped reduce the risk perceptions around China at a difficult time earlier this year. But the longer that the U.S. dollar weakness persists and the weaker the dollar gets, the more unsettled the world would become. Why? In a nutshell, dollar strength was pushing the global rebalancing through a way that only a globally coordinated policy initiative could achieve otherwise. Dollar strength was a great vehicle by correcting the relative growth and differential between the U.S. and the rest of the world. Strong U.S. growth, the result of a more advanced internal rebalancing, lets other economies rebalance as the U.S. absorbs some of their disinflationary pressures. Our FX team has described the current U.S. dollar dynamics as a correction ensconced with a secular bull run that is not complete. In today's note, and this was back in April 14th, we argue the term of the dollar's trajectory is not only likely to materialize, but it's also for more supportive of global rebalancing than a weaker dollar. So they're looking for the dollar to strengthen. They're just saying that this was a correction in what they believe is a secular bull market. So I don't know what that cock and bull story was about. You know, being referenced over here. I don't know what they're talking about the yen. I mean, I don't know about that. I didn't even look at that, but I did read about that because these guys and gals know their stuff. They run circles around everybody. Citi's a joke. Goldman Sachs is a joke. That, like I said, they're not even in the same league. They're not even in the same freaking area code compared to these guys and gals. Well, anyway, let's take a look at what's up on the docket. So, you saw that in the story. Reuters poll looking for 202, last month 215. I don't give a shit. You know, excuse me, I'm going to be, a private payroll. So let's send down his fucking joke ass. I don't care what he thinks. He's nobody. We'll look at manufacturing. Manufacturing was key. This is another number to focus on because last month we lost 29,000. So if we were to see something like it gained, and let's say it was revised down, but again, that would help support the number. So if we had a number like 243, and of that 243, I'm just saying, not likely, but I'm just saying that you saw like 18,000 gain in manufacturing, that'd be huge. And if you saw anything like it whittled away this entire last month's number, that would be freaking huge. That would be like ridiculously huge. Nobody cares about government payrolls. Doesn't mean anything. When you look at government payrolls is when you're looking at, let's say we're at the tail end, of a growth area, and the market started to slide back, and then we get a decent jobs number, but then there's a crap load of government jobs. Then that's where they're looking at the cup, the glass is half empty. Say, oh God, look. So they go, let's say they're looking for a lousy number. Not now, but I'm saying at the end of a certain cycle, and they're looking for something like maybe a gain of only 10,000, and they get a gain of, let's say, 55,000. But of that 55,000, 20,000 was jobs, government job. Then that's when you're looking at government payroll. Then, and you say, oh wait a minute, you know what? So the bonds sell off, and then you go, because the market was preceding, let's say, 15,000, and they get like 53,000. But then the market turns around and zips right back because it says, oh, that's all made up government jobs, so that's not real growth in the economy, and so the bonds come right back. Or, i.e., the dollar rallies initially and then sells off. That's when you're looking at government payroll. Nobody gives a rat's, on government payrolls right now. So the unemployment rate, this isn't going to be as much. I mean, if it were to tip down to 4 point, like it'd be like, piling on. You know what I mean? Like a tackle on football, and everybody starts piling on. So if you saw something like 249, and then you saw manufacturing up like 25, which basically would have done almost all the way with this one. And then you see it tick down to 4.9%, they'll be like it's piling on. Then people would be like, rushing into the dollar. It's just another thing. They'd be like, oh my God, if this continues in June, are we going to be at 4.8? They'll have to raise. So that's where you would see it start to pile on. Average hourly work week, average hours work week will be key. I mean, it was 34.4 last time. The thing 34.5. This probably makes sense because as the job market gets a little bit tighter, this would be key where if you saw this jump up to 34.7, that means they're trying not to hire anymore and they're pushing people more towards overtime. But then it's like, at what point does the levy break? So it could bode for further strength coming in the next few months. So if you saw something like jump up to 34.7. Let's see. Now, where the hell is average hourly? Okay, here's average hourly rates. So they had a nice rebound at 0.30. Remember when that was the reason I kept telling people they're not going to raise in March. Then all the know-it-alls that are sitting in the freaking Ivy Towers in Wall Street that don't know a damn thing were saying we're going to raise in March. And a ton of some very, 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 very good, not only good traders, but big traders were betting on the bonds falling because they were sure there was going to rate rise. And I said, when the average hourly earnings went down, there was no way they would raise in March. There was no way. It wasn't going to happen. And they just totally ignored that, and they paid the price. So if we saw, I mean, I don't know what it's going to be. They're saying the poll is going to be 0.30, which is pretty solid then. I mean, overall, well, we did that. The prior month had been a negative. We had a nice rebound. So if you were to see 0.3 again, once again, that's going to strengthen the case. And once again, it'd be piling on. So if you saw something like I said, 248, and then of the 248 in manufacturing, after we lost 29,000, maybe the gain was 25,000. So it's almost like it almost made that flat. And then you saw the unemployment tick down to 4.9%. And then you saw the average hourly earnings, and let's just say the earnings came in at 0.30. But then if this ticked up to 34.7, they'd be like, oh hell, Katie barred the door. Because you know what? They're going to come busting through. And then you not only would see the dollar rally, you would see continued gains going into the early part of next week. That's how you want to go and read the numbers. You look at the numbers in totality. You don't just, I mean, it's okay to go off the headline print. That initially moves up. So people wonder, why is it swinging up and down? Because they go off of the initial print, but then you have to see if there's revisions, okay? And like if there were revisions up, that would even add more. And then you look at the things that are at the precipice that can only squeeze it higher. And that would be like this work week would be increasing. Obviously, this wasn't at the precipice because we had a negative the prior month. But if this comes back at 30, then it would look like the prior month was kind of like an anomaly. And then if this ticked down to 4.9, once again, it was spooked the market, then people get very defensive as far as expecting the Fed. It'd be like, well, there's a good chance they could raise in June, and if they don't raise in June, oh man, you can pencil in July. I mean, would be the perception. So this gives you an idea on how you want to go on and view the number. I'm saying how you want to trade it. You're like, I just don't get it. It swings real wild, then it swings back the other way, then it swings real wild. Talk about, let's say, the dollar. Then this is what you look for. So if you were to see a good number, like let's say 248, and initially the dollar rallied, but then you saw the average hourly one, okay, and average hourly work week dropped down to 34.4, and the manufacturing jobs lost, the next one lose another 5. They lose 12, then you say, wow, that was just, it's kind of like fluff. What they gained is fluff, because you know what? They came in weak on the average hourly earnings, which means they're probably not going to raise too quick. The average hour work week even slid back, so they're definitely slowing down. And the manufacturing had already lost 29, they're expecting -5, and they got -15. No way, this is not likely they're going to raise this soon. Now it's probably going to be maybe the fall. That's where you would see then the dollar initially rally on the headline print, but then around and come back. That's how it works. Vladimir says, where does one get into, like you were showing the U.S.? It's a subscription to Reuters. Yeah, you can contact Reuters. Yeah, it is. I mean, you can have all these things set up the way you want. I mean, I have them set up differently for things that I look at. I kind of set up the things the way that I want to go with. Or like I have one just for central banks. And I just restart my computer. That's why everything's kind of a bit slow loading up. So here I've got, well, this one's breaking news. This one got the Bank of England. You see the ECB. Okay. And then for gold, FX. This was the RBA. This is the BOJ, and the Swiss National Bank. So, but I go and set it up the way that I want to go and set it up. I don't use the charting package. The only time I use, it's there, but the only time I look at the charting, this is for the Chinese yuan. The only time I use the charting package, not really going to use it, but I'm saying I've got this up here, is if it's on Sunday, and if it's on Sunday, and like they're open, like I'm already getting quotes in Reuters, like about 3 hours before y'all get the retail open. I'm already getting quotes in Reuters. Just to come out of New Zealand. But you can set it up the way you want. But I mainly just do it for news. That's the only reason I do it for. I know it. I don't use the charting and all that junk. The good things you can get to, like the COT numbers and all that stuff if you want to write inside of the release. So it's pretty comprehensive. But anyway, going back to the news. So we're going to take a look at where we stand as we come into the report. And let's switch back to the charts. So here we are in the euro. We talked about this yesterday. I mean, when it was way up here, and I was underwater at the time, and we talked about how people got blown out once we got past 1571. That just opened the floodgates. But how we failed here before 1621, and we only went up like 18 pips above 16. That's why I kind of gave you the hint that this really, I mean, this was the last of the gas or air, and the longs, the trend longs. You got to tip their hat to them. They got lucky here at the end with the RBA. That gave it the extra juice. But what I thought we'd break lower. Now, once again, here's the old bias pivot, 1365, and you can see, rally up, push back, go through it. Now it's support, dips through it, but we get a hammer. And this is not like 5-minute chart. These are 2-hour bars. Dip through it, support. We're going to test the other side, support. Rallies up, support again. And once we actually lose it, you notice how once we lose it, notice how. And see, notice the key thing here. You see, it closes, but then it quickly comes back. And most of these times, they won't even close below it. I mean, you get here, and then notice how you get like a little graveyard, not graveyard, you get like a doji. It's almost like, it's not quite, but it's almost like a spinning top here because the market's lost momentum. So then the market pushes further and comes right back up again. But you can see most of the time, it's a bias pivot because most of the time, notice it's just the wick circle going through it, not the actual closes. Once you get the close and it says pushing it by, then you see the acceleration lower. That's something I came up with. I know they used to have one on the floor. They had the pivots. You take the high, the low, you divide it by 3 or 2 or so. I don't pay attention to that crap. I'm just visually, I look at it, and that's how I come up with my bias pivots. You can see right here, rallies up, it's spanked, knocked back, rallies up, real good battle zone. Once again, this whole bias pivot working with the champ. It's slapped back again. Once you get above it, it didn't even take off real fast. Once you get above it, and the market pushed up, now you flip the bias that way. So now on the pullbacks they're supported, and then wham, it's up there. I never expected it to go way up here. Not like that with this kind of speed. Once again, my targets initially were 1376, 1492, and 1730. But this last run up was so ridiculous that even if anyone wanted to buy it, they have to wait till we got down about here for longs to say, okay, now I'm going to get long in for long haul. And I just don't see it at this point. The reason is, like I said, it's not, I mean, technically it's bullish. My point is just like the Morgan Stanley article was showing, is there's nothing going on in the Eurozone. And it's only a matter of time whether the Fed raises. If we get a good report, some people are going to think it could come in as early as June, but it probably come closer to July. If the report isn't so great, unless it gets just totally filleted, if the report's not so good, then it's probably in the fall. One way or the other, the Fed's going to be raising. So I'm just saying is that's why I feel that any gains for the euro are going to be quite limited. And anybody that made their money in this area, they took their chips off the table. They took them off the table, especially when we got here. They're not going to turn around and buy it. That's what my point was. They weren't going to turn around and buy here and launch back up since they had huge gains. And so I'm sure they must have met most, maybe not all, but a good chunk of their targets if someone was really, really bullish. So now we've come back down here. So why put on positions ahead of the peak? I'm talking about like in here. No, I mean, unless it came dramatically lower, they would. So we'll have to wait. And so now, yeah, you'll probably find some support in here, but to relaunch for another upside move, I don't think so. I think you'd have to come down here towards sub 113. Then you might see some people going, I'm willing to buy it. I really think Euro's going to 120 and all that jazz. I don't see that, but I'm saying that's what you see. That's what I'm saying. They're going to have to go and work lower. But I think that ultimately, the economy will still, the U.S. economy will continue to remain pretty decent, and that will weigh on this, and people are going to come to that notion is this, it's only a matter of time. They will be raising again. and then it's gonna limit what the euro can do to the upside. So you want to focus in this zone here. Obviously, if the number were to come out crappy, you're not going to have to think about it, but you have to be ready. Right here. That's what you want to be looking at. Now, if the number comes in a real boffo, strong number, well then, yeah, they're going to come down here. They may even blow through 38, and then they're going to whatever. But I'm saying this is the area, I would say, of value, right here. You see all these touches down here and here. So my guess is this would be the area here. And I guess we should look at the 78%, just in case. If the number comes out crappy, it's not going to make any difference at that point because then we're going to rally, but I think the year will be a sell. But 1304 would be the 78%, so we'll mark this off. You have to be prepared just in case. If they were to get a ridiculous number, then you know the wheels are going to fall off the caboose. And actually, on the upside, I'm not really concerned about the numbers here. This is more about levels. I mean, I'm not concerned about the fib. We can throw a fib, but I'm not really concerned about the fibs on the upside because the levels are really staring me in the face big time. I mean, if you want a confluence, you could say. So, depending on, I mean, you'll see wild swings in the P. So, one thing you could look at. Here's 1474. That's not saying that. 1529 would be the 61%, which would coincide or confluence with this zone here. So if you want to mark it off, you can. The zone there is more important than the actual fit in that context. So it would be 1529. You wrote 1387. But it's this zone. I mean, we'll have to see how the report comes in, but this is a zone you want to look at. And those are the bullish. I'm sure there'll be people that'll be willing to buy here if we get, but we'll get into the zone, especially down this 1338. Well, it's already time for break, so we'll catch y'all back on the other side. And put it to the headlines, although I really don't know what difference it's going to make with the headlines. But once again, that gentleman recommended it, which that's fine. And we'll just put it here and then catch on a little bit. Okay, everybody, welcome back to the crossover. Yasser says, where's a good place to take profits in Aussie shorts, and where do you see it going in the long term, 1 month? Well, I mean, I don't trade for the longer term, but we've talked about wow, they got past our, well, they made to our target, and they're going beyond our target, which was the 74.50, and I told you I was kind of kicking myself for not even trading this, but I don't even trade during the Asia session, but doggone, I still should have gone taking at least a small short, so I'm kind of ticked about myself, because we've been looking for that thing for a long time, and it just set up so beautifully, and it was just pretty ridiculous. I just didn't at least take... you know, take a small position. And we talked about. This move up here was just, I mean, after everything we looked at, this right here was just ridiculous. There's no reason I shouldn't have just gone taking that. I mean, it just lined up perfectly with everything. This was our target, 74.50, so I'll be doggone if we ever go back. 73.61, I think, I'll tell you what, right now is pretty doggone good. Obviously, we have the NFP, so if the jobs plan comes in stronger, it's going to weigh further, but we're in pretty good shape right here. I mean, if you're already, short, you have some pretty good profits. That's pretty doggone good right there. Let's see, so if we were to look at this, I was looking for something at the 50%, but look, that's been a huge move. I mean, it's already reached my target that I was looking for, which is 74.50. We've been on top of this like crazy. I still can't believe what an idiot. I can't believe I didn't take a position up there to grab at least some. So 73, look at that. 73.34 is a 50%. I'd be getting the hell out of Dodge. So 73.34 is 50%. I think the jobs number will come out fine, but there's no guarantee. But I mean, here's the way you have to look at it. He always makes a pretty good point. Trader John T. Because here's what you look at. I mean, we'll probably get some pretty good bounce off of this area. It looks like what about 73.21. I mean, here's the deal here. Let's try to squeeze that. Okay, see how that area is right here? And really right here, 73.36 is pretty solid. See these touches in here, here, falls right before 73.36, and then the wheels fall off the caboose for 500 pips. So we're right there. So here's the thing, when I was referring to Trader John's, like he says lots of times, he goes, person will say, well, I'm short from up here. Let's say they're short from up here. Let's say they're short for 76.50. They have 300 pips, and they go, well, I mean, like he likes to say, it's a free trade. I'll just hang on. But what's your downside? Well, I'm waiting for 73.34. Okay, well, you're short from 76.34, and at this point, you've got 270 pips. How much are you willing to risk for another 30 more pips? Well, I mean, I'm in the black, yeah, but even though you're short from way up here, and maybe you're short from here, how much are you willing to come down? Because look, we just took the leather leg down right now. Now, we talked about this before. Remember how I told you all the different personalities, how the Euro likes to make you scream uncle, the cable likes to hit, you get all these wicks because it likes to take out stops on both sides, and that the personality for the Aussie, it loves to trend. Once it gets going in one direction, we just went over this yesterday. It's like, you better get the hell out. You're like, it can't fall any further. It can't fall any further. It can't fall any further. It's probably going to work a little lower, but once again, how much? I mean, if you think that we're going to get down to 71, then you're like, I don't care. But we're so close to support. The only thing that might happen, if we have the good jobs number, they'll probably pop down here, but I bet they pop right back up. So if you're saying, I don't care, I think that the jobs number is going to be good, and I'm not going to get out. Okay, then what I would recommend doing is having a limit at 73.32. And let them fly down here, and they'll probably pop right back up here, and then they'll meander or whatever. That way you already have your limit. Personally, for me, I'd be like, screw this. It'd probably be a good jobs number, but it's not worth it for me to risk all these gains up here, depending on where you're short, for an extra 20 pips. Or 30 pips. It's just not worth it. You know there's going to be cover in the air. They'll overshoot it. They always do. My guess is if you're trying to squeeze the last bit of blood out of the turnip, I'd be putting like 73.32. Let them go down there, hit you, and they'll pop back up. Because look, we've already fallen 100 pips. since the Asian session. I mean, how much more do you want to go and get out of that? So, and Yasser says yes, it loves to trend. So, I mean, I'm asking you in a kind of like in a rhetorical way, not like to give you a hard time. I'm saying like, dude, how much more do you want to pull out of this? I mean, if you were short from here, you just made 100 pips from last night. How much more do you try to squeeze it? Now, if you're saying, I don't care, that's my target, well then, that's fine. Just realize, you know, what you're risking. Although, on a good jobs number, you're still going to get some more juice. It's just, how much do you want to risk for the extra bit of juice? How much, you know, you've already made 100. How much of that 100 do you want from last night? You made 100. How much of that 100 do you want to risk to get an additional 30 pips? That's how you have to look at it. So, I mean, but I don't know what you're short from, but well done. Yeah, this is what I was looking for. You know, we've talked about this. This was my target, 74.50. And obviously something happened last night. I don't even look at the Asian session. But something happened to knock me down again. But it's like my saying that I coined, it's all relative. So, I mean, you know, if it's fallen 100 here already after falling this much, how much more do you expect to get out? Once again, like Yasser said, it trends. And when this thing trends, you better get the hell out of the way. Because it will run your you-know-what over. It can't go lower. I mean, this is ridiculous. It can't go lower. I mean, I'm going to load the boat because this is ridiculous. I mean, because it can't go lower. I mean, oh my God. Okay, I'm out. I've lost all my money. And then now, that's the bottom. And then once it starts trending, get the hell out of the way. Here we go. Like I said, it's like a train. You miss the train, and you can go chasing that train down the tracks, but that train isn't going to stop. It just keeps on going. Now, after they took everybody out up here, I'll be doggone if the train stopped up here, and now here we go down. Now the train's going south of the border. So, yeah, like Yasser says, it loves to trend. Yasser says his target was 72.55. Let's take a look at that. It's NFP day, so no, I think things happen like that. So Yasser says he likes 72.55. Oh, come on, Yasser. I mean, my goodness gracious, you're trying to go for the very, very bottom of the zone, which it probably eventually will get there. But the thing is, and that's what I've got, 72.60, which you got 72.55. But look how far it's fallen. I mean, if you're like, I don't care, I think the losses, it's probably going to eventually make it down here. But here's what might happen. It might come to 50% here, rally all the way back up to about 74, 75, and then eventually come back in. So you would end up giving up almost 200 pips. That's my point. Nothing moves in a straight line. Although it does trend, you do get pullback. So if you said, my target is 78.20. Okay, and I said, wow, so you're at the top of the zone, 76.93. I don't care. My target is 78.20. Yeah, but look how much you gave back. You see? Almost 200 pips. You eventually got your target, but you gave 200 pips in the meantime. That's my thought process here. Is you're coming to the 50%, this is going to be huge. You've lost 100 overnight. I mean, do what you want. I mean, do what you think is best for yourself, but I'm just saying how you want to look at that. But well done. Personally, I can't hang on to trades that long. So, I mean, you know, props to you. I just don't have the whatever to hang on to. We already talked about cable. I mean, I just think we talked about it when we were down here. Remember that? And I think the potential we could get down to 43.69 and overshoot this a little bit before we see the rally. But we talked about the shit shape. You know that big firms, not even trading firms, commercial firms had to go in and hedge when the rally up here, take them and hedge them, take that, get those shorts because we got that Brexit. So that is pretty obvious. Dollar yen. We were talking about Morgan Stanley. They think 108 is going to cap it. I said that yesterday, but I have no idea what this currency is going to do. I really don't know. I know we were talking about that 105 being 161%. I mean, eventually maybe we can come down to 105 and tick it off, and then I think it's a pretty good buy at that point. But you know, right now nothing's really happening. This currency, I just don't have a take on this at all. Oh, Yasser says he's short from, oh, be doggone, he's short from 78. And he had it 76, then it's 75. Holy smokes. What the, oh my God. Dude. Dude sells it at 78, adds at 76, and says, oh my God, well, you got some hefty coin. Holy smokes. Well, anyway, so let's take a look here at the dollar CAD. This is continuing to strengthen. I thought this was a good area for scalpers and day traders to get out. And obviously, those Canadian fires even pushed it higher. But I said, we're going to go higher because look at this fall. Look at that. Oh my goodness. But I thought that was a good area for scalpers and day traders to exit here. And I thought, well, we'll shoot a little bit, but they kept on going. Now they came back to the 27.94. You see that? They took it out by just a hair and then reinserted themselves. I mean, that's what I'm saying is, I would not be taking the other side there, but if it was me, I would have gone and taken that here, expect them to congest a little bit, go sub 27.50, hold in here 27.28, and then reassert itself. But those Canadian fires really spooked the market, so they pushed it even further. So that's what happened there. But if it had been me, I'd have been long gone, and I'd be saying, oh my goodness. But once again, those Canadian fires happened right when we hit this area, and then forget it. It just took off. Let's take a look at the SPOOs. Well, that's nice. Toe says, hi, Polly, thanks for all you do. This is now my regular essential listen for every morning. Your ES 2034, 2030 is called looking good. Great work. Yeah, we're actually going to, that's from Toe Chun. We're actually going to go on and go right into the SPOOs right now. Yeah, it looks like we're heading that direction. Hang on a moment. So here's the target here, not trying to brag or anything, just saying where we stand right now. So there it is. And yeah, and Toe's right. That's what we're looking at. I've been bullish, hardcore bullish to SPOOs in the U.S. economy for a very long time, and bullish to SPOOs. But when we got up here, this is when I got my rear end smacked in the crude. So when we got up here, I was like, this is a bunch of big bull, you know what? And that's what I thought, this is it. It's too far, too fast. It's going to hurt the SPOOs. And I got bearish that same day. It hit my target 20.04 which that was just my daily target. It wasn't like I was looking for that the whole time. But for the last 2 months, when people were telling me, oh no, the Fed's going to raise, the SPOOs are going to correct, I was like, it ain't going to happen. I'm telling you right now, it's not going to happen. So that's why I was still staying very bullish. And this is my daily target at that time. But when we got that, I said, no way, that's it. It's over for the SPOOs. And the next morning I came on, and we were trading like at 94, 92. And I said, I'm very bearish. And then I gave my targets. And so it's come to. And I actually sold in here, right here, 2075.5. But I covered that next morning when it came down so fast, covered it 61.25. Although I thought 57.5 was a possibility. We did get to 57.5 and we haven't went lower. So 34.25 is the bias pivot. So we're going to open this up so you can see a little more clearly. 34.25 is the bias pivot. And you can see how important this has been. Let's see if we can pull this back. Let me make this a full now. You see how important 34.25 has been? Resistance, pull back. Once we got through it, it was Katie barred the door, off to the moon we go. We come back, a little bit of battle, but when we lose it, it accelerates the downside. If you can't see it, but there's a little bit of trouble here, and once we get through it, we're back off to the moon again. We come back down, and it's support. We bounce off of it. When we go through 34 and a quarter, they accelerate lower. When we get back up it, it's back to the moon. We go back through it, the wheels come off the caboose. We get back through it, there's a fight. You can't see it here, but I'm just showing here. There's a fight here, a pretty big battle. The bears lose out, and off to the moon we go again. It falls up short, but it falls back, and it finds support at the bias pivot. We take back off to the moon again, and then we fail. We come down here. You see this line here? It's support. The wind got through it, but not the close. When they can't hold it, the wheels fall off the caboose, and down we go. And then on the way up, from 1802, 204, almost 40 handles. We run out of gas up in here. There's a real big battle, and they're battling left and right. And then they fall through it, because these are just some wicks. And it starts accelerating, but it's not followed too much. Go back in here. Of course, I don't think a 4 hour, but 2 hour, but this is a 4 hour, so we can get a better perspective. We fall back, but they're able to hold them. They come back here, they battle again at 34 and a quarter. They lose the fight. They come right back off of the 10 count. The boxer on the mat tries it again, gets knocked back again. Once we get through it, wham, it starts running again. We come back to 34 and a quarter for support. We take off again. We come back to 34 and a quarter for support. We retest 34 and a quarter for support. We rally up. So you can see the significance of 34 and a quarter. Hence my point about my bias pivot. So this is actually the target, really, because I had this off and I just kept it that way because that's how I drew it. But you see one here, that's actually to the pip, or to the tick. You see, you measure it as it breaks its neckline. So right there, it actually hits 34 and a quarter to the handle. But my thinking is they'll overshoot it to 30. And then we have 26, which is 161% of this move here. We'll take a look at that. You see that? 26. Almost like really like 26 and a quarter, but I mean, Mach Snicks is what that used to say. So, and this is 26.75. That's 26. The 161% is actually 26 and a quarter. So, you know, now with NFP, anything can happen, and you're going to see all kinds of crazy overshoots. But I'm just saying that's where it looks like the market wants to go down here to 34 and a quarter, the old bias pivot. Now you can see how they always overshoot in here. My thinking that they'll test it down at 30. Will they make it around 26? I don't know. It might because of NFP. We'll just have to see. And Scott says, great analysis, just great analysis. Cool, like your levels. What time frame do you draw them? No, the levels are just based on whatever. I mean, I'll pull up a 5 minute. I'll give you an example. Just to, this is actually on a 30 minute. I'll show this here. Hold on. It's just wherever there's the most touches. And I guess someone who is doing volume analysis, they would say, well, that's where the volume is. But I guess that makes sense because that's where the touches are. So we'll go. So you can see here, it has nothing to do with the thing. I just go with the levels based on. You see the touches here? You see that? CS72 is right here. So that is double dotted because it has more significance. And that wasn't just drawn out. This is on level 4. So if I open this up, you can see here. Sometimes they'll coincide. You see how 62.50? I just go through the touches. And notice how the market, when it fell down to 48, it ran out of gas right at 62.50. I remember even tweeting that out here. On this run up here, I tweeted that out in real time on Twitter. I said, scalpers should look to go on an exit on this run up here. And we had that run. It was when we bottomed out, like, what was it, 48 and a quarter or something like that. And we ran out. So it's just all to do with the touches. That's all it is. But I think Blake might be over here. See if I can hear him.